If I told you that your comfort zone is the single reason you're still losing money, would you believe me? Most people wouldn't. Because everyone says, find your zone. Trade what feels comfortable. Don't step outside your strategy. Sounds reasonable, right? But here's the problem. The market doesn't reward comfort. It punishes it, brutally and consistently. Today I'm going to show you why every trader who stays in their comfort zone is destined to remain unprofitable, and why the only path to consistent profits goes straight through the discomfort you've been avoiding. Welcome back to the channel. In this video, you'll learn why comfortable patterns make you predictable to market makers, how small, comfortable position sizes kill your growth potential, why you close winners too early because of emotional comfort, and how to break this cycle once and for all. By the end of this video, you'll understand. Your comfort zone isn't safety. It's a prison. Let's start with the biggest misconception. People think success in trading comes when you find your system and feel comfortable with it. I've heard this hundreds of times. Just find what works for you. Only trade what you understand. Stay in your lane. It sounds like solid advice, but here's what actually happens. You find one pattern that worked a couple times, let's say a triangle breakout, or a bounce off support, or some indicator setup, and you think, this is it, my edge. Now you only feel comfortable with that one pattern. You wait for it. Over and over. You miss dozens of other opportunities because they don't fit your comfort zone. And here's the brutal part. Market makers know exactly what retail traders find comfortable. They know you love breakouts. They know you love round numbers. They know you love clean setups. So they create fake breakouts. They sweep liquidity at round numbers. They make setups look clean right before reversing. Your comfort is their paycheck. Every time you think, this feels right, someone on the other side is thinking, perfect, another one. The market doesn't care about your feelings. It cares about taking your money. And the easiest money to take? Money from traders who only do what feels safe. Here's the thing. Your brain wants you to survive, not thrive. Evolutionarily, we're wired to avoid uncertainty, avoid risk, avoid discomfort. Thousands of years ago, that saved lives. Today, it kills your accounts. Let me explain what happens on a neurochemical level. When you see a familiar pattern, one you've traded before, your brain releases dopamine. The feeling of recognition, the feeling of control. Even if that pattern failed the last 5 times, your brain still pulls you toward it because it's familiar. Now imagine the opposite. You see a new setup, maybe a really powerful one, but you've never traded it before. Your brain immediately sounds the alarm. Danger, unknown, avoid. The amygdala, the part of your brain responsible for fear, lights up. The rational part of your brain says, this is a good entry. But the emotional part screams, too scary, skip it. And you skip it. Then price moves exactly how you thought it would. And you beat yourself up. But the next day, it happens again. This is called status quo bias. Your brain prefers familiar losses to unfamiliar wins. Let me tell you a story. Guy in my community named Kyle, smart, disciplined, excellent chart analyst. But he had one problem. He only traded one strategy, range breakouts. That's it. For months, for years. He missed trending moves. He missed pullbacks. He missed reversals. Why? Because they were outside his comfort zone. I asked him once, dude, why don't you take these pullbacks? They're clean. He said, I just don't feel them. Breakouts, I understand. You see that? Not, they don't work. Not, I don't have an edge, but I don't feel them. That's the comfort trap. You're not trading what works best. You're trading what feels safest. And the market punishes you for it every single time. Here's what else happens. Your comfortable patterns become predictable. When you only trade one type of setup, you develop a rhythm. You enter at the same type of levels. You exit at the same type of targets. You place stops at the same obvious spots. And guess what? Algorithms pick up on that. Market makers pick up on that. They see thousands of retail traders all doing the same comfortable thing, and they exploit it. Stop hunts aren't random. Liquidity grabs aren't accidents. They're designed to punish predictable, comfortable trading. Let me tell you something that might sting a little. The setups you feel most comfortable with are probably the least profitable ones. Not because they're bad setups, but because everyone else feels comfortable with them too. Think about it. What's the most comfortable trade for retail traders? A clean breakout above resistance with high volume. Looks perfect, right? Strong momentum, clear direction, easy stop placement. Your brain loves it. You feel confident. You size up. And then what happens? Price runs 10 pips, stalls, and reverses right into your stop. Every single time. Why? Because that comfortable setup is visible to everyone. Every retail trader on TradingView sees it. Every Discord group is calling it. Every YouTube tutorial teaches it. And market makers know this. They know exactly where your entry is. They know exactly where your stop is. They know you feel comfortable here. So they create the perfect trap. They let price break out just enough to trigger your entry and everyone else's. Then they reverse it, sweep all the stops, and move price in the real direction while you're sitting there confused, wondering what you did wrong. Here's the truth. The best entries almost never feel comfortable. In fact, they usually feel terrible. Let me give you an example. You're watching a strong downtrend. Price has been falling hard. Every bounce gets sold. Then you see a tiny pullback. Price taps into a demand zone. But momentum is still clearly down. Every fiber of your being says, don't take this. It's going to keep falling. That discomfort? That's often where the real money is. Because while you're uncomfortable, smart money is accumulating. While you're waiting for a better entry, institutions are building positions. While you're looking for comfort, they're looking for value. I remember a guy named Marcus in my community. He had this rule. He only took trades that felt right. He'd wait for perfect confirmation. Clean charts, clear trends, no ambiguity. Sounds disciplined, right? Wrong. He was just avoiding discomfort. And because of that, he missed every major move. The big trend reversals? Too scary, not enough confirmation. The early breakout entries? Too risky, wanted to see more proof. The pullback entries and strong trends? Too uncomfortable, price was still moving against him. By the time everything felt right to Marcus, the move was already over. He'd enter late, get minimal profit, or worse, enter right before the pullback. And he couldn't figure out why he was always late to the party. One day I told him, dude, you're not waiting for the right trade. You're waiting for the comfortable trade. And by the time it's comfortable, it's too late. He didn't like hearing that. But 3 months later, he messaged me and said, you were right. I've been training myself to take only the worst entries. Because that's what comfort does. It trains you to wait until everyone else sees what you see. And when everyone sees it, the opportunity is gone. Let's talk about position sizing. This is where the comfort trap gets really expensive. Most traders think they're being smart by trading small. I'm managing my risk, they say. I'm being disciplined, they say. But here's what's really happening. You're staying comfortable at the cost of your growth. Let me paint a picture. You have a $5,000 account. Your strategy says you should risk 1 to 2% per trade. That's $50 to $100. Reasonable, right? But that feels scary. So you risk $20 instead. Just to be safe. You take a trade. It's a good trade. Your analysis is perfect. Price moves exactly as you predicted. You make $40. You feel good. You pat yourself on the content. But here's the reality. You just spent hours analyzing, waiting for the setup, executing the trade, and managing it. And you made less than you'd make working 1 hour at a regular job. That's not progress. That's comfort disguised as discipline. And it gets worse. Because you're risking so little, your wins don't mean anything. A $40 win on a $5,000 account? That's 0.8%. It doesn't move the needle. It doesn't change your life. It doesn't even cover your coffee that day. So what happens? You start taking more trades to compensate. You start looking for more setups. You start lowering your standards. And suddenly you're overtrading, not because you're greedy, but because you're trying to make your comfortable position size actually matter. Let me tell you about a trader named Lisa, smart woman, extremely risk-averse. She'd been trading for 2 years with a $10,000 account, and in those 2 years, she'd grown it to $10,400. You read that right. 2 years, $400 profit. That's a 4% return. You could have made more in a savings account. When I asked her what was going on, she said, "I'm just being careful. I don't want to lose money." But here's what I noticed. Her win rate was 65%. Her strategy was solid. Her analysis was good. Her problem? She was risking $25 per trade on a $10,000 account. That's 0.25%. Even when she won, she made $35 to $40. She was so comfortable with her tiny risk that she made it impossible to grow. I told her, "You're not being careful. You're being scared. And fear disguised as caution is still fear." She didn't like that. But I showed her the math. At her current rate, even with a 65% win rate, it would take her 15 years to double her account. 15 years, and that's assuming she never took a losing streak. The uncomfortable truth is this: growth requires uncomfortable position sizing. Not reckless, not stupid, but uncomfortable. If your position size doesn't make you a little nervous, you're probably not risking enough to actually grow. I'm not saying you should risk 10% per trade. That's idiotic. But if you're risking 0.25% because it feels safe, you're not trading, you're practicing, and practice doesn't pay bills. Here's a question most traders never ask themselves. What are you actually afraid of? You'll say, "I'm afraid of losing money." But that's not the whole truth. Because if you were really afraid of losing money, you'd study harder, you'd backtest more, you'd journal every trade, you'd do the work that actually reduces losses. But most traders don't do that. So what are you really afraid of? You're afraid of being uncomfortable, and that fear costs you way more than losing money ever could. Let me explain. When you see a trade setup that's outside your comfort zone, what happens? Your brain runs a cost-benefit analysis in milliseconds. Option 1. Take the trade. Unfamiliar territory. Uncertain outcome. Emotional discomfort. High stress. Option 2. Skip the trade. Stay comfortable. No immediate pain. Safe feeling. And your brain picks option 2 every single time. Even if option 1 had a 70% win rate and a 3-to-1 reward-to-risk ratio. Your brain doesn't care about statistics. It cares about avoiding discomfort right now. But here's what your brain doesn't calculate: the long-term cost of comfort. Every time you skip an uncomfortable trade, you're not just missing that one opportunity. You're reinforcing a pattern. You're training yourself to avoid growth. You're cementing the habit of choosing safety over success. And over time, that compounds. 6 months later, you're still trading the same setups, still making the same mistakes, still at the same account balance. Why? Because you've trained yourself to be comfortable with mediocrity. Let me tell you about a trader named Jason. This guy had been stuck at break-even for 18 months, not losing, not winning, just spinning his wheels. I watched his trades for 2 weeks, and I noticed something. He had incredible chart reading skills. He'd call moves before they happened. He'd identify key levels perfectly. But he never took the trades. I asked him, "Dude, you called that reversal perfectly. Why didn't you take it?" He said, "It didn't feel right. Too much uncertainty. Too much uncertainty." That's code for too uncomfortable. And here's the brutal part. Jason wasn't protecting his account by skipping those trades. He was protecting his ego. Because if he took the trade and it failed, he'd have to deal with being wrong. He'd have to face the discomfort of a loss. But if he never took the trade, he could always tell himself, "I would have been right," without actually proving it. That's the comfort trap. It's not about the money. It's about avoiding the emotional pain of being wrong. Now let's talk about the fear of losing money. This fear is real. It's valid. Money represents security, freedom, options. Losing it hurts. But here's what most traders don't realize. Staying comfortable guarantees you'll lose money. Just slowly. Think about it. If you only trade comfortable setups, you're only trading what everyone else trades. and what everyone else trades is manipulated by market makers. If you only risk comfortable amounts, you'll never grow your account fast enough to make trading worthwhile. If you only hold positions for comfortable durations, you'll close winners early and hold losers too long. Comfort doesn't protect you from losing. It just makes the losses slower and more painful. I remember my mentor telling me something that completely shifted my perspective. He said, "You're going to lose money either way. The only question is, will you lose it while learning and growing, or will you lose it while staying comfortable and stagnant?" That hit me hard, because he was right. The market doesn't care about your comfort. It's going to test you regardless. You can either face that discomfort head-on, learn from it, and become a better trader, or you can avoid it, stay in your comfort zone, and slowly bleed your account dry while convincing yourself you're being safe. Let me guess your trading routine. You open your charts. You go straight to your favorite time frame. Maybe it's the 5-minute, maybe it's the 1 hour, maybe it's the daily. And you analyze everything from that one time frame. You look for setups there. You make decisions there. You feel comfortable there. And you wonder why you keep getting chopped up or why you keep missing the big moves. Here's why. You're not seeing the full picture. You're only seeing the picture your comfort zone allows you to see. Let me explain what's actually happening. Every time frame tells a different story. The daily chart shows you the institutional trend. The 4-hour shows you swing structure. The 1 hour shows you intraday momentum. The 15-minute shows you execution zones. The 5-minute shows you entries and noise. If you only look at one time frame, you're trading blind. It's like trying to navigate a city with only one street visible. You might know that street really well, but you have no idea what's happening on the next block, and that's how you get trapped. Here's a common scenario. You're a 5-minute trader. You see a clean breakout on the 5-minute chart. Volume looks good. Momentum is strong. You enter, and immediately price reverses and stops you out. What happened? You zoom out to the 1 hour chart. There's a massive resistance level right where you entered. Every 1 hour trader saw it. Every swing trader saw it. But you didn't see it because you only look at the 5-minute chart. That's the comfort trap. You're so used to your time frame that you ignore critical information from other time frames. Let me tell you about a guy named Derek, day trader, scalper, lived on the 1-minute and 5-minute charts. Fast entries, fast exits. He loved the action, the constant movement, the dopamine hits, but he was losing money consistently. I asked him, "Do you ever check higher time frames?" He said, "Sometimes, but I don't really need to." I'm a scalper. Wrong. Dead wrong. One day I sat with him and made him analyze a trade on multiple time frames before entering. 1 minute, clean breakout, looked perfect. 5-minute, strong momentum, good volume. 15-minute, approaching a major resistance zone. 1 hour, deep in a downtrend. 4 hour, rejected from this level 3 times in the past week. Suddenly that perfect 1-minute breakout looked like a trap. And guess what? It was. Price reversed exactly at that resistance and dropped hard. Derek stared at the screen and said, "I've been trading blind this whole time." Yes, he had. Because he was comfortable on the 1-minute chart. He understood the noise. He felt like he had control. But control is an illusion when you're only looking at one piece of the puzzle. Here's the truth. The time frame you're comfortable with is rarely the time frame you should be trading from. Why? Because comfortable time frames match your personality, not the market structure. If you're impatient, you gravitate toward lower time frames. Lots of setups, constant action. But those time frames are noisy, manipulated, and full of false signals. If you're overly cautious, you gravitate toward higher time frames, fewer trades, more time to think, but you miss momentum, execution zones, and precise entries. The best traders aren't comfortable with one time frame. They're fluid across multiple time frames. They use the daily for bias, the 4 hour for structure, the 1 hour for setups, the 15-minute for entries. They don't care what feels comfortable. They care what the market is showing them. Let's talk about something most traders won't admit. You're not really trading your own analysis. You're trading other people's comfort. You're in a Discord server. Someone posts a chart. EURUSD long setup, clean breakout, high probability. 50 people react with fire emojis. 10 people comment, I'm in. Suddenly you feel it, that pull, that validation. Everyone else sees it, so it must be good, right? You take the trade. And here's what happens next. You get stopped out. Price reverses, you check the Discord. Half the people got stopped out too. The other half went silent. Nobody talks about the loss. But 2 hours later, someone posts a winner, and everyone celebrates. This is social proof trading, and it's one of the most expensive forms of comfort you can buy. Here's why it feels so good. When you trade alone, you carry all the psychological weight. You have to trust your own analysis. You have to deal with uncertainty by yourself. You have to own your mistakes. That's uncomfortable. But when you trade with a group, that weight gets distributed. You're not alone anymore. If the trade works, you share the glory. If it fails, you share the blame. We all saw the same setup. It was a good trade, just bad luck. Market makers hunted us. See how that works? The discomfort of being wrong gets diluted, and your brain loves that. But here's the problem. You're not learning anything. When you take a trade because someone else posted it, you skip the most important part of trading, independent analysis. You don't study the charts yourself. You don't build conviction yourself. You don't develop your own edge. You just copy someone else's comfort. And when that trade fails, you have no idea why. Because it wasn't your trade. It was theirs. Let me tell you about a woman named Rachel. She'd been trading for a year, and she was in 4 different Discord servers, 2 Twitter groups, and a Telegram channel. Every day, dozens of setups, everyone calling trades, everyone posting charts, and Rachel would take 5, 6, 7 trades a day based on what other people posted. I asked her once, "Why did you take that trade?" She said, "I don't know, everyone was talking about it. It looked good." That's not analysis. That's following the herd. And the herd is almost always wrong. Here's why. The people posting in those groups aren't trading your account. They're not managing your risk. They're not dealing with your emotions. They post a setup, get some validation, and move on. Whether you win or lose doesn't affect them. But it affects you. And here's the worst part. When you rely on social proof, you become dependent on it. You can't take a trade unless someone else validates it first. You second-guess your own analysis because you're waiting for confirmation from the group. You lose confidence in yourself because you've outsourced your decision-making to strangers on the internet. I've seen this pattern destroy traders. They start out learning, they study, they practice, they develop skills. But then they join these groups looking for community and support, and slowly they stop trusting themselves. They stop doing their own analysis. They just wait for the next signal, the next hot take, the next high-probability setup from someone with a flashy chart and a bunch of followers, and their accounts bleed, not because they're bad traders, but because they traded their independence for the comfort of belonging. Let me tell you something my mentor told me when I was caught in this trap. The crowd will always make you feel comfortable and keep you broke. Profitable traders are comfortable being alone with their decisions. Think about that. Every time you check Discord before taking a trade, you're choosing comfort over competence. Every time you need someone else to validate your analysis, you're admitting you don't trust yourself. And if you don't trust yourself, why would the market reward you? Here's something nobody talks about. Most traders aren't destroyed by one big loss. They're destroyed by 1,000 small, comfortable losses. Let me explain what I mean. You take a trade. It goes against you. You hit your stop loss, minus $30. You feel it. You're annoyed. But it's not devastating. It's not account blowing. It's just $30. So you move on. The next day, another trade, another stop out, minus $25. Again, it stings a little, but it's manageable. It's within your risk parameters. It's acceptable. A week later, you've taken 12 trades, 7 losses, 5 wins. Net result, minus $80. And here's what happens in your mind. It's fine. I'm still learning. Losses are part of the game. I'm managing my risk well. But you're not managing anything. You're normalizing failure. You've become comfortable losing. And that comfort is killing you slowly. Because here's the truth. Small losses don't feel dangerous. They don't trigger alarm bells. They don't force you to change. They just quietly drain your account while you convince yourself you're doing everything right. It's like a slow leak in a tire. You don't notice it immediately. The car still drives. Everything feels normal. But 3 months later, the tire's flat and you're stranded. Let me tell you about a trader named Connor. Good dude, disciplined, never risked more than 1% per trade. Kept a journal, followed his plan. But he was stuck in this cycle of comfortable losses. I looked at his stats over 6 months. 180 trades, 98 losses, 82 wins. Average loss, $35. Average win, $42. Win rate, 45.5%. On paper, this looks almost break-even, right? Wrong. Because of commissions, slippage, and spread, he was down $1,200 over 6 months. And when I pointed this out, you know what he said? Yeah, but I'm not blowing my account. I'm staying consistent. Consistent at what? Losing? That's not consistency. That's comfort disguised as discipline. He'd gotten so used to taking small losses that he stopped questioning why he was losing. It's just part of trading, he'd say. You can't win them all. True, but you can't lose 55% of your trades and call that acceptable. Not if you want to be profitable. The problem was this. His losses felt manageable. They didn't hurt enough to force change. So he kept doing the same thing over and over, expecting different results. Here's what comfortable losses do to your psychology. They create a baseline of acceptable failure. Your brain says, losing $30 is normal. Losing $50 is normal. This is just how trading is. And once you accept that baseline, you stop fighting it. You stop improving. You stop analyzing why you're losing. You just shrug it off and take the next trade, and the cycle continues. Meanwhile, profitable traders are the opposite. They're deeply uncomfortable with every loss, not emotionally wrecked, not revenge trading, but genuinely bothered. They ask, why did this fail? What did I miss? How can I avoid this next time? They treat every loss like a problem to solve, not a fee to pay. Let me give you some brutal math. Let's say you're comfortable losing $40 per trade. You trade 5 times a week. You lose 60% of those trades because you're not really improving, just staying comfortable. That's 3 losses a week, $120 a week, $480 a month, $5,760 a year. And that's with small manageable losses. You're not blowing your account. You're not taking huge risks. You're being responsible, but you just lost almost $6,000 to comfort. Think about that. $6,000 because your losses felt acceptable, because they didn't hurt enough to make you change. Here's the shift you need to make. Stop being comfortable with any loss. I don't care if it's $10 or $100. Every loss should bother you enough to make you review it, learn from it, and adjust, not emotionally, not with anger, but with discipline. Because the moment you become comfortable losing, you've given up on winning, and the market will take everything you're willing to comfortably give away.